And in a significant development, Shell PLC has inked an agreement to offload its onshore oil assets in Nigeria to a local consortium for a sum of exceeding about $1.3 billion pending regulatory approval. Our Shell's integrated gas and upstream director confirmed the details in a statement released today. It says the deals are important, emphasize on Shell's strategic focus on optimizing its portfolio and channeling disciplined investments into deep water and integrated gas ventures within Nigeria. This strategic move aligns with Shell's broader objective of exiting the demanding operational landscape of the Niger Delta region. In addition to an initial transaction amount, Shell expects to receive additional payments totaling up to $1.1 billion. The purchasing consortium, known as Renaissance, includes ND Western, Aradol Energy, First EP, and Walt Smith, and Petrolin. All right, let's get a sense of how this sale of its Shell's PLC's onshore business will impact the oil and gas industry in Nigeria and other matters arising. Joining me now is Desola Sumoni, joins us via Zoom from the UK. Great to have you, Desola.
Thank you for having me on the show, Ladi.
Right. So we've seen one of the statements from Shell that would say their strategic objective is to exit the challenging operating environment in the Niger Delta region. So this sale doesn't look like what should be cheered at this time.
Thank you for that question, Ladi. I think we need to look at it in the broader context of things, right? Like you mentioned, Shell is moving from, is divesting its onshore business and moving into deep water offshore business, which is more lucrative and it is less problematic. And over the years, Shell has been operating in Nigeria for close to 100 years, and they've had some challenges in terms of vandalization, oil spills, theft, sabotage, and as well as clashes with the local communities, which leads to expensive lawsuits. But in the broader context of things, in the last couple of years, 2-3 years, we've also seen a retreat or a divestment from Western IOCs. We've seen ExxonMobil divest from onshore business in Nigeria. We've seen Italian Eni divest. We've seen Equinor also divest. And this, again, citing the same reasons about the challenging environment, it is important to note that these agreements they've only been agreed in principle and they've not been approved. Many of them are still pending approval. But this tells us something. It also raises question about the business or the operating environment in Nigeria, particularly coming at a time where we desperately need foreign investment. So what does this imply for foreign direct investment, for example? What does this say to potential investors who are looking to come into Nigeria when they see this huge divestment from IOCs? But on the other hand, it is positive in terms of we now see more and more involvement of local oil companies in oil exploration in Nigeria. So that's the positive bit.
All right, but looking at the consortiums at this point, they refer to as a Renaissance. Do you think they'll be able to navigate, the difficulties Shell is having to move away from?
That's a good question. Now that they seek or they've acquired, the Shell's business, I think that is entirely their own is entirely their own responsibility now to deal with, maybe being local, that might, kind of, maybe they can reach some agreements with the local community, or they can form a kind of, reach some agreements anyways to see if they can kind of reduce the sabotage or the theft. I think maybe it might help that, okay, these are my people, so I think it might help that they're local to be able to kind of reach some agreements with the local community, with the local militias, etc. to kind of
they can understand the language, I guess.
Yeah, that's my people, kind of thing. It is possible. I was not sure whether that's going to happen, but that's a possibility.
Right, we'll definitely keep tracking that as a developing story, at this time. But let's look at the inflation data for December. It came out yesterday, and that's definitely hotter than expected. And if we put up that data now, we see headline inflation rose more than what we had in November. If you put up that data for me, it's hotter than expected, even higher than the FDC's forecast there. I see 28.92% for December. That's headline inflation. Food inflation keeps going higher, at 33%. That's a former percentage for unemployment, before the adoption of new data. So that's for food inflation. So talk to me, how are you seeing this data?
Thank you for that question, Laddie. A famous statistician said all models are wrong and some are useful. So we forecasted 28.7%. Our inflation came in at 28.9%, which our forecast error is very little. We put a 0.5% margin of error, and so in terms of direction, we're right. In terms of magnitude, we're also right, given our margin of error. Now that is that. Next, in terms of these numbers are huge. The last time we saw anything like this was in around 1997 or 27 years ago, which shows that inflation is quite significantly high, and also is among the highest in the region in sub-Saharan Africa. I think the nearest one would be Ghana, which is around 21%, if my guess is right. So which shows that inflation is quite huge. And among the drivers, we know the key drivers are we saw food inflation also increase quite significantly. Core inflation is also higher. But the drivers are, one, the FX issue, the knock-on impact of the liberalization of the foreign exchange market, and number two is the transportation and logistics challenges or the transportation and logistic costs as a result of the removal of PMS subsidy. So those are the main drivers. Obviously, we still have our supply bottlenecks, etc. The legacy structural issues still persist, but those are the key drivers at the moment.
Right.
Now, in terms of the implications.
Yes. Yeah, go ahead.
In terms of the implications, I think there's more and more pressure now on the central bank to keep on tightening, to still continue or to extend the tightening cycle, when globally we are expecting a hold or we're expecting a switch in monetary policy stance from tightening to loosening as global inflation reduces. But in Nigeria, we are still seeing inflation trend upwards.
And definitely, talking about the MPC, it'd be very interesting to see our new central bank governor actually presiding over that meeting. Definitely, we're all looking out for that, and we're still waiting for a timetable to let us know when it's gonna start. And definitely, we're expecting more tightening, at this time. But we're seeing money supply growth about 39.33% to 72.01 trillion. Definitely, this has an impact on inflation at this time.
Definitely, by classic Eco 101, they will tell you inflation is simply when we have too much money chasing to feel goods, right? And this is the idea. We are seeing money supply increase. We are seeing quite significantly by up around 33% month on month. And this is part of why we are seeing higher inflation, but also more and more pressure on the foreign exchange markets. We're also expecting we are seeing some mopping up. The central bank is trying to mop up some of this excess liquidity using open market operations. The last stop rate for open market operations, I think, was around 17%. But at the same time, we are seeing national treasury bills, the stop rates for treasury bills declined to around 80%. That's the 1 year treasury bill to around 8-point-something%, I beg your pardon. So it seems as if on one hand we are seeing more tightening we are seeing higher stop rates from OMO. On the other hand, we are seeing lower stop rates from the treasury bills market. So I think some alignment between the fiscal and monetary policy would be good. I think also having an actual monetary policy meeting to just set the agenda. Yes, we are seeing some actions here and there. We are seeing some policy notes here and there, but an actual policy meeting where the central bank governor can set the agenda, and just set the expectations for the year. I think that would be super helpful at this time.
All right, we'll definitely be looking out for that. But let's get to the global oil market now. We're still seeing it's still a very volatile market, at
Indeed,
this time. But we're seeing the disruptions there with the issues with the Houthi situation. It's definitely pushing prices up. What are you seeing for 2024 when it comes to oil prices?
Okay, let me start with where we are and I take to what we see for 2024.
Right.
Where we are now, we are seeing quite a lot of volatility in the oil market, as well as many other commodities markets. But we are seeing also oil trade in a tight range. Despite the volatility, we are seeing oil trade in a tight range. On the one hand, we are seeing the tensions or the instability in the Middle East, particularly the Red Sea region, which is one of the trade routes for oil tanks and other, apart from commodities trade, other trade as well goes through that. So that is, it's, although it has not yet begun to physically affect a supply of oil, but if it persists, then it's likely going to begin to affect oil. We're also seeing something like a cold snap. So currently in Europe and as well as North America, we're seeing a cold snap, and that is affecting oil production. For example, in North Dakota, temperatures have declined to around -8, -15 degrees Celsius, and that is affecting oil production. In particular, this backing shale oil rig or oil well in North Dakota, we are seeing around 425,000 barrels shut in because of the extremely cold weather. We are seeing, like I mentioned, this instability in the Middle East. But also we are seeing weaker demand, prospect of weaker oil demand, and all of these factors are keeping oil in a tight range. In terms of output, in terms of outlook, I think three main factors are going to drive oil prices this year. On the one hand, that will be outputs, OPEC's decision, OPEC's outputs decision, OPEC plus outputs decision. That will be one key factor driving oil prices this year. Number two will be geopolitical tensions, whether this, this instability that we see in the Middle East, whether it escalates or persists. Also, the Israel-Hamas crisis, if that also escalates and moves region-wide, I think that's going to drive oil prices quite significantly. Also, the path of monetary policy. So currently, there's a meeting in Davos where, investors are just trying to get cues about what is going to happen with interest rates. Are we going to see more holding? Are we going to see more tightening? And they expect some economists or some policymakers have suggested that we need to tighten some more. Although we think that this year we're going to begin to see some loosening,
right.
Some forecasts as early as Q1. So those key factors are what's going to drive oil prices this year.
Yeah, and definitely with half the world, heading to the polls, also in 2024, definitely we're going to see a lot of volatility
Definitely.
at this point.
Right,
Thank you so much. It was great having you, Desola Simone, Senior Analyst, Financial Derivatives Company. Thank you.
Thank you for having me.